The shift did not begin with a dramatic announcement or a surprise press conference. It began quietly in market pricing, in yield curves, and in the language policymakers used when they thought no one was paying close attention. While headlines still debated whether interest rates in the UK would stay higher for longer, a different story was already forming underneath. Investors were no longer asking if rates would be cut, but how soon. The disconnect between public perception and market behavior is a first clue that something important has changed. For more than 2 years, the Bank of England maintained one of the most aggressive tightening cycles in its modern history. The logic was straightforward. Inflation surged, credibility was at risk, and policy had to be restrictive enough to break price pressures. That phase is now ending not because inflation has magically returned to target, but because the balance of risks has shifted. What once looked like a necessary discipline is beginning to look like an economic liability. Headline inflation in the UK has fallen faster than many forecasts predicted. Energy prices, once the dominant driver of inflation, have normalized. Supply chains that were tangled during the pandemic have largely untangled. Shipping costs, input prices, and delivery times no longer push prices upward at the same speed. These are not abstract trends. They show up directly in consumer price data, producer prices, and corporate earnings calls. Inflation momentum matters more than the absolute number, and that momentum is clearly down. Yet this alone does not explain why rate cuts may arrive sooner than the public expects. Central banks do not react to inflation in isolation. They react to inflation relative to economic damage. And in the UK, the cost of keeping rates high is becoming increasingly visible. One reason many observers miss this shift is timing. Monetary policy works with long and variable lags. The most painful effects of high rates often appear after inflation has already begun to fall. In the UK, those lags are now colliding with reality. Millions of households locked in fixed-rate mortgages during the low-rate era. As those fixed terms expire, refinancing occurs at rates 2 or 3 times higher. This is not a gradual adjustment. It is a shock. Monthly payments jump, discretionary spending falls, and consumer confidence weakens. The inflation problem of yesterday becomes a demand problem of today. The Bank of England is acutely aware of this. While it publicly emphasizes vigilance against inflation, its internal models focus on forward-looking stress. Wage growth, once a major concern, has begun to cool. Job vacancies have declined from their peaks. Hiring intentions have softened. None of this suggests a recession is guaranteed, but it does suggest that tight policy is now doing exactly what it was designed to do, perhaps too effectively. Markets sense this shift before it becomes official. Gilt yields began to fall not because inflation vanished, but because investors started to believe that the peak of restrictive policy had passed. Futures markets adjusted expectations for the policy path. When enough participants independently arrive at the same conclusion, price signals change. These signals are not predictions. They are risk assessments, and they increasingly point toward earlier easing. Another signal lies in how policymakers communicate. Central banks rarely announce pivots abruptly. Instead, they soften language. Phrases like further tightening may be required gradually turn into policy is sufficiently restrictive. That shift has already occurred. Once a central bank believes rates are restrictive enough, the debate internally moves from how much more to how long. And once the how long question dominates, rate cuts are no longer distant hypotheticals. They are planning scenarios. There's also a structural issue unique to the UK. Unlike the United States, the UK economy is more sensitive to interest rates. Household debt exposure is higher. Mortgage repricing cycles are shorter. Small and medium-sized enterprises rely more heavily on bank credit rather than capital markets. This means the same policy rate produces stronger real economy effects. What looks manageable in aggregate data can feel painful at the household and business level. This creates a narrow policy window. If the Bank of England waits too long, the risk is not just slower growth, but financial strain that compounds. Defaults rise, credit conditions tighten further, and confidence erodes. Central banks aim to engineer soft landings, but soft landings require timely adjustments. Waiting for inflation to hit target before acting may sound prudent, but it ignores the asymmetry of damage. Inflation that is falling can be tolerated. Economic fractures are harder to repair. Importantly, none of this means the Bank of England has won the inflation fight in a triumphant sense. It means the nature of the fight has changed. The danger is no longer runaway prices. It is over-tightening. That is why expectations have shifted from endurance to timing. Investors are not betting on generosity. They are betting on necessity. Public narratives often lag because they focus on statements rather than constraints. Central banks operate within political, financial, and social limits. High rates strain public finances through higher debt servicing costs. They strain housing markets, a politically sensitive area in the UK. They strain businesses already dealing with post-Brexit trade frictions and weak productivity growth. These pressures do not show up in a single data release, but they accumulate. This is why the coming rate cuts, when they arrive, may surprise those who believe central banks only react once inflation is fully subdued. In reality, they react when the expected future cost of inaction exceeds the risk of acting. That threshold appears closer than most people think. The key insight is not that rates will be cut, but that the logic of policy is already turned. Markets reflect this logic earlier than headlines do. By the time rate cuts become obvious to everyone, they are no longer news, they are history. The real signal was never the announcement. It was a quiet realization that holding rates high was no longer a sign of strength, but a growing vulnerability. To understand why interest rate cuts are approaching faster than expected, you have to look beyond the headline inflation number and into the mechanics beneath it. Inflation does not fall randomly. It slows when specific pressures weaken. And in the UK, several of those pressures are now reversing simultaneously. This is what makes the current moment different from earlier false hopes of disinflation. The first force is a cooling of the labor market. For much of the inflation surge, wage growth was the Bank of England's primary fear. Prices could fall, energy costs could normalize, but if wages kept accelerating, inflation would reignite through services and domestic demand. That scenario is now losing momentum. Job vacancy data has been trending downward from its peak. Firms are hiring more cautiously. Surveys show that companies are less willing to raise pay aggressively, not because they want to, but because margins are under pressure. When wage growth slows, acts like a delayed brake on services inflation, which is exactly the category central banks watch most closely. This slowdown does not mean the labor market is weak in an absolute sense. Employment remains relatively high. But central banks care about direction, not comfort. Wage growth has stopped accelerating, and that alone changes the policy calculus. Inflation driven by wages is persistent. Inflation driven by temporary shocks is not. The Bank of England sees a shift from one to the other, and that reduces the need for prolonged restraint. The second force is a base effect, often misunderstood, but critically important. Inflation is measured year over year. When prices rose sharply last year, those increases eventually fall out of the comparison window. Even if prices continue to rise modestly, inflation rates can fall quickly once those extreme months roll off. In the UK, last year's energy and food price spikes created exactly this setup. As those months pass, inflation mechanically declines. Central banks know this in advance. They do not wait to be surprised by it. They model it and they plan around it. This matters because public debate often treats falling inflation as a sudden victory. In reality, much of it is arithmetic. The question is whether new inflationary impulses are replacing the old ones. In the UK, there is little evidence that they are. Instead, demand side pressure is weakening, which reinforces a disinflation trend created by base effects. The third force is demand exhaustion. High interest rates do not just slow inflation. They reshape behavior. Households facing higher mortgage payments spend less. Businesses facing higher borrowing costs delay investment. Credit growth slows. This process takes time, but once it gains traction, it feeds on itself. The UK has reached that stage. Consumer spending has softened not because confidence collapsed overnight, but because financial reality tightened gradually and then suddenly became unavoidable. Retail data, surveys of household sentiment, and corporate earnings guidance all point in the same direction. Consumers are more cautious. This matters for inflation because demand-driven price increases require willingness to spend. When that willingness fades, pricing power fades with it. Companies stop raising prices not out of generosity, but out of fear of losing volume. These three forces, cooling wages, base effects, and weaker demand, interact. Together, they create a downward inflation trajectory that is difficult to reverse without a new shock. For the Bank of England, this trajectory is more important than the current inflation print. Policy works forward, not backward. Critically, the UK's situation differs from that of other major economies. The United States, with its larger fiscal impulse and stronger productivity growth, can tolerate higher rates for longer without immediate strain. The euro area faces fragmentation risks but benefits from longer mortgage fixation periods in some countries. The UK, by contrast, sits in an uncomfortable middle. Its growth is weaker, its households are more rate sensitive, and its margin for policy error is thinner. This structural vulnerability explains why inflation falling faster than expected has outsized implications. In a robust economy, falling inflation might simply justify patience. In a fragile one, it demands action. High rates stop being a safeguard and start becoming a threat. The Bank of England also watches expectations closely. Inflation expectations, both market-based and survey-based, have stabilized. They are not spiraling upward. This gives policymakers room to maneuver. Central banks fear one thing above all else: losing control of expectations. As long as households and firms believe inflation will continue to fall, aggressive restraint becomes less necessary. That belief is now embedded in pricing behavior and wage negotiations. There is also a financial stability dimension. Prolonged high rates stress balance sheets quietly before they break loudly. Commercial real estate valuations adjust downward. Highly leveraged firms face refinancing risk. Banks become more cautious. None of this shows up directly in CPI, but central banks monitor it constantly. The UK experienced a sharp reminder of market fragility during past episodes of gilt volatility. That memory has not faded inside Threadneedle Street. All of this leads to a crucial point. Falling inflation is not simply good news. It changes the hierarchy of risks. When inflation was rising, the dominant risk was doing too little. Now the dominant risk is doing too much. Central banks rarely admit this openly until after the pivot, but the shift happens internally long before. This is why forecasts that assume rates will stay high until inflation hits target often miss the turning point. They treat policy as reactive, when in reality it is anticipatory. By the time inflation reaches target, the economy may already be slowing too sharply. Central banks aim to avoid that outcome, even if it means cutting rates while inflation is still above the ideal level. The implication is subtle but powerful. Rate cuts are not a reward for defeating inflation. They are a response to the changing balance of damage. In the UK, that balance is tipping faster than expected because the economy cannot absorb prolonged restriction without consequence. Understanding this mechanism explains why market expectations have shifted so decisively. Investors are not ignoring inflation risks. They are recognizing that inflation is no longer the only problem in the room. When central banks face multiple risks, they choose the one they fear most. And increasingly, that fear is not inflation reaccelerating, but economic strain becoming irreversible. This is the logic behind earlier than expected easing. It is not optimism. It is realism. By the time inflation starts falling, the real pressure of high interest rates is no longer theoretical. It shows up where policy cannot hide it, in balance sheets, cash flows, and confidence. In the UK, these pressures are now converging in a way that leaves the Bank of England with far less flexibility than its public posture suggests. The most immediate stress point is the mortgage market. Unlike economies where homeowners lock in long-term fixed rates, a large share of UK borrowers face periodic resets. During the era of ultra-low rates, millions secured fixed deals that are now expiring. When they refinance, the jump in monthly payments is not marginal. It is often hundreds of pounds. This is not an abstract macroeconomic concept. It is a direct transfer of income from households to lenders. Consumption falls not because people want to save more, but because they have no choice. This mortgage reset effect hits in waves. Each quarter, a new cohort of households rolls off low-rate deals. The cumulative impact builds even if housing prices remain relatively stable. Retail spending weakens. Services demand softens. Arrears rise slowly at first, then more visibly. Central banks do not wait for default statistics to explode before acting. They watch the trajectory. And in the UK, that trajectory is uncomfortably clear. Small and medium-sized businesses face a parallel squeeze. SMEs are the backbone of the UK economy, yet they are heavily reliant on bank lending rather than capital markets. Higher rates raise interest expenses directly and tighten credit conditions indirectly. Banks become more selective, covenants tighten, and refinancing becomes more difficult. Many firms respond by cutting investment, freezing hiring, or passing costs to customers where possible. But when demand is already weakening, pricing power disappears. Profit margins compress, and financial resilience erodes. This matters because business distress transmits quickly into employment risk. Even a modest rise in layoffs or reduced hours feeds back into household income. The result is a negative loop. Weaker demand leads to weaker revenues, which leads to cost cutting, which further weakens demand. High rates amplify this loop rather than contain it. The housing market itself is another pressure point. Property transactions slow when borrowing costs rise. Construction activity cools. Developers delay projects. This does not necessarily trigger a dramatic crash, but it does suppress activity across a wide ecosystem. Contractors, suppliers, estate agents, and local services. Housing is not just an asset class in the UK. It is a transmission mechanism for economic confidence. When it stalls, sentiment follows. Public finances also feel the strain. Higher interest rates increase the cost of servicing government debt. This constrains fiscal flexibility at a time when growth is already weak. While central banks are formally independent, they cannot ignore the broader macro financial environment. Tight monetary policy combined with limited fiscal room increases the risk of policy conflict and economic stagnation. That is not a comfortable position for any central bank. Financial markets add another layer of pressure. Gilt yields, currency movements, and liquidity conditions all respond to expectations about growth and policy. The UK has already experienced how quickly confidence can evaporate when markets sense imbalance. Policymakers are acutely aware that stability is not guaranteed simply because inflation is falling. Stability requires credibility, and credibility depends on avoiding unnecessary stress. This is where the concept of systemic risk becomes relevant. Systemic risk is not about one sector failing spectacularly. It is about many sectors weakening quietly at the same time. Individually, each stress looks manageable. Collectively, they reduce resilience. High rates maintained for too long can turn manageable stress into something more dangerous. The Bank of England's challenge is not to predict a crisis, but to prevent conditions that make one more likely. This shifts the role of rate cuts. They are no longer primarily about stimulating growth. They are about easing pressure before cracks widen. That is why the timing matters so much. Acting too late can be far more costly than acting slightly early. This logic explains why central banks often cut rates even when economic data looks okay on the surface. Aggregate figures can mask distributional pain. Unemployment may remain low while financial stress rises. Inflation may fall while real incomes are squeezed. Policymakers must interpret these signals holistically, not mechanically. Another often overlooked pressure is confidence itself. Businesses and households make decisions based on expectations of the future, not just current conditions. When high rates persist without a clear path forward, uncertainty rises. Firms hesitate to invest. Consumers postpone spending. This hesitation can slow the economy even in the absence of dramatic shocks. Clear signaling of a future easing path can stabilize expectations before actual cuts occur. Importantly, none of this implies that the Bank of England is panicking. On the contrary, earlier rate cuts can be a sign of control rather than weakness. They signal that policymakers believe inflation is contained enough to shift focus. The alternative, holding rates high until damage becomes undeniable, risks forcing sharper, more disruptive cuts later. This is why the debate has quietly moved from whether cuts are justified to how much damage has already been done. Markets, which aggregate countless individual risk assessments, reflect this shift earlier than official statements. Bond yields adjust. Credit spreads react. Currency volatility increases or subsides based on perceived policy direction. At this stage, the question is no longer whether high rates are restrictive. That is already clear. The question is how long the economy can tolerate that restriction without lasting harm. For the UK, with its structural sensitivities and limited buffers, the answer is increasingly not much longer. Rate cuts, in this context, are not a sign that inflation has been defeated completely. They are an acknowledgement that the costs of maintaining maximum pressure now outweigh the benefits. Central banks rarely say this directly, but their actions reveal it. This is the hidden pressure shaping policy decisions. It is not visible in a single data point or headline. It is visible in the accumulation of strain across households, businesses, markets, and public finances. When all of these pressures align, policy choices narrow. That narrowing is what brings rate cuts closer, not as a surprise, but as an inevitability. When interest rate cuts finally arrive, the biggest mistake investors make is assuming the story is over. In reality, the announcement is often the least important part. Markets move on expectations, positioning, and relative advantage long before policy changes become official. By the time central banks act, much of the repricing has already happened. This is why rate cuts should not be interpreted as a simple green light for risk assets. Cuts do not occur in a vacuum. They occur because something in the economic environment has weakened enough to force a response. Understanding what is weakening matters more than the cut itself. Historically, the first beneficiaries of rate cuts are not equities, but bonds. When investors believe rates have peaked, long-duration assets reprice. Yields fall, bond prices rise, and curve dynamics shift. This happens before the first cut, not after. In the UK, gilts tend to respond early because expectations adjust quickly once policy credibility shifts. Investors who wait for confirmation often miss the most significant moves. Currencies tell a more complex story. Rate cuts can weaken a currency, but only if they surprise the market or occur faster than peers. If cuts are well telegraphed and globally synchronized, the impact can be muted. For the pound, the key question is not whether rates fall, but whether they fall relative to other major economies. If the Bank of England cuts earlier or more aggressively, sterling faces pressure. If others follow a similar path, the effect is less dramatic. Equities require even more nuance. Lower rates reduce discount rates, which can support valuations. But if cuts are driven by economic stress, earnings expectations also fall. This creates divergence. Rate-sensitive sectors may benefit, while cyclical or highly leveraged companies struggle. The idea that rate cuts equal bull market is one of the most persistent and misleading simplifications in finance. Banks, often assumed to benefit from lower rates through improved credit conditions, can face margin pressure. Savers, who enjoyed higher yields for the first time in years, may see returns shrink. Borrowers gain relief, but only gradually. These distributional effects shape market narratives and political reactions long after the initial cut. Another critical factor is timing. Markets rarely wait for central banks to act. They front-run. By the time the first cut is announced, asset prices may already reflect several cuts ahead. This is why reactions on the day of the announcement can feel underwhelming or even negative. Investors are not responding to the cut itself, but to whether it exceeds or disappoints expectations. For traders, this environment rewards relative thinking rather than absolute bets. The question is not will rates fall, but who benefits more, sooner, and more predictably. For long-term investors, the focus shifts to resilience. Companies and assets that can perform through slower growth and changing policy regimes tend to outperform those dependent on cheap capital alone. There is also a psychological dimension. Rate cuts signal that policymakers see enough risk to change course. That can unsettle confidence even as financial conditions ease. Volatility often increases around pivots, not decreases. Positioning becomes more cautious. Liquidity preferences shift. This is not a backdrop for blind optimism. Perhaps the most important takeaway is that policy pivots are rarely obvious in real time. They feel ambiguous, contested, and uncomfortable. Headlines argue over whether cuts are premature or overdue. Markets oscillate. Narratives conflict. This confusion is not a bug. It is the environment in which opportunities and risks coexist. By the time consensus forms, by the time rate cuts feel obvious, the adjustment phase is largely complete. Prices have moved. Positions have been taken. The remaining upside or downside is often smaller and more fragile. This is why experienced investors pay more attention to shifts in logic than to official decisions. In the case of the UK, the logic has already changed. Inflation is no longer the only constraint. Economic strain, financial sensitivity, and structural fragility now weigh just as heavily. Rate cuts, when they come, will reflect this reality, not a sudden change of heart. The real lesson is not about predicting the exact month of the first cut. It is about recognizing when a regime has shifted. High rates once signaled discipline and control. Now, they increasingly signal risk. That transition is subtle, but it is decisive. Markets move ahead of certainty, not after it. They move when the balance of fear changes. And right now, the fear is no longer that inflation will spiral out of control, but that holding rates too high for too long will do lasting damage. By the time interest rate cuts are obvious to everyone, they are no longer an opportunity. They are a confirmation. The story has already moved on.